Welcome back, my friends. Wall Street investment bank Goldman Sachs just announced that it is planning major layoffs this month. Goldman Sachs said that the investment bank will 8% of employees, starting in January. Goldman is the first major Wall Street investment bank to cut jobs. But it is not expected to be the last because deal volume has collapsed. Goldman is preparing for a tougher deal environment in 2023. This video continues our coverage of the wave of layoffs sweeping the United States. What does it mean for the economy? And what does it mean for the future of the United States? But before we get into all of that, please press the like button and leave us a comment below. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. Goldman Sachs is a storied investment bank if there ever was one. And today, we are hearing reports that Goldman plans on cutting up to 8% of its employees. 2023 will bring a much tougher deal environment. The layoffs will impact every division of the investment bank. And the job cuts will begin in January, according to sources. Goldman is reportedly conducting the job cuts ahead of an upcoming conference for Goldman shareholders. This is the annual meeting during which management is expected to present performance targets. Goldman typically pays bonuses to its employees in January. There is some speculation that the timing of the layoffs could be a way to preserve bonus dollars for remaining employees. Wall Street investment banks are preparing for what they think will be a lower revenue environment in 2023. Pretty much all of the Wall Street investment banks experienced a boom in deals over the past 2 years. But the deal boom sputtered out. A hiring freeze was put in place. As the macroeconomic environment weakened, Goldman was the first major firm to cut jobs in September. But that layoff was really only the appetizer course for what is to come in January. It was a relatively shallow cut that only impacted a few hundred employees. Other investment banks followed with similarly modest cuts. Citigroup, Barclays, and Morgan Stanley, which cut about 1,600 workers last week. But the upcoming layoff at Goldman is by far the biggest job cut on Wall Street so far. I think that you can expect other investment banks to follow suit again. Many firms will have to go back to the drawing board and right-size their organizations. It's not just Goldman, said Alan Karp, CEO of the Options Group. Firms overhired, and now they will have to overfire, too, Karp continued. Goldman's planning is ongoing through next month, and the round could be smaller than 8% when it is finalized, Karp also said. That is especially true if people voluntarily leave, the person with knowledge of the situation added, Karp said. Anonymous sources are saying that as many as about 4,000 employees could be cut. Layoffs are expected to be focused on underperformers or bankers who are working in consumer businesses. Goldman is de-emphasizing consumer businesses because of low deal potential. Goldman hired aggressively during the pandemic as banking deal volumes surged. But what a difference a year makes. Their current projection is 14% less than last year. We are looking to rein in expenses, said Goldman CEO David Solomon at a conference for financial firms last week. We continue to see headwinds on our expense lines, particularly in the near term, Solomon said. We've set in motion certain expense mitigation plans, but it will take some time to realize the benefits. Ultimately, we will remain nimble and we will size the firm to reflect the opportunities set, Solomon continued. Goldman Sachs has said that it is reinstating its long-standing tradition of yearly performance-based job cuts. Typically, Goldman cuts the bottom 1% to 5% of employees every year, based on performance. The current layoff is expected to be 1% of employees, which means less than 1,000 positions. Goldman Sachs currently has 47,000 employees. The job cuts are spread across all departments, according to a report published in the New York Times. Goldman Sachs declined to make a spokesperson available to comment on the layoffs. The U.S. economy is teetering on the verge of a recession and dogged by runaway inflation. And that has led to a steep downturn in deal-making volume. Goldman Sachs' revenue has lagged this year, disappointing Wall Street analysts. This year's possible resumption of layoffs come amid a dramatic slump in revenue. The Wall Street giant helmed by David Solomon. Goldman reported earnings of $2.93 billion in the second quarter. That is around half of its reported earnings for the second quarter of 2021. Investment banking was source of the revenue and earnings shortfalls. Goldman's revenue from investment banking is 41% lower than in the same quarter of 2021. Trading revenue was actually up 32% year over year. But that did not fully make up for the shortfall in investment banking. Corporate mergers, initial public offerings, and other big corporate deals are down sharply overall in 2022. That is because the Federal Reserve has aggressively raised interest rates this year. So far in 2022, JP Morgan Chase and Morgan Stanley also posted steep profit declines in both revenue and earnings. The investment banking division of JP Morgan Chase reported a 54% revenue decline as compared to the same quarter in 2021. Morgan Stanley stunned the financial world, saying that its equity underwriting fees were down 86%. Wall Street investment banks are taking a hard line on demanding that employees come back to the office after the pandemic. Solomon, who famously called working from home an aberration, has signaled the return to office with particular force. As first reported by the Post, Goldman told workers in a memo last month it planned to lift all COVID protocols after Labor Day, a sign it. Goldman CEO Solomon says that the investment bank will not accept any excuses for employees not to come back to the office. Job cuts on Wall Street come as layoffs at technology companies are just revving up. Layoffs at big tech companies started with a quiet trickle, but now appear to be accelerating. This includes established big names, Web3 unicorns, and everything in between. A year ago, this seemed unthinkable. But now it seems like an ominous sign of things to come. Here is the list of some of the companies that have announced layoffs. Snap, owner of Snapchat, announced a 20% reduction of employees. This amounts to approximately 1,300 workers. Snap also initiated a major restructuring of their online platform. Apple announced that it is cutting 100 positions and slowing hiring and spending. Oracle, the worldwide software, has cut hundreds of positions but declined to say how many. Most job cuts are said to be in the customer service unit for U.S. customers. Crypto trader Coinbase announced a 20% workforce reduction. Crypto lender Genesis cut 20% of its workforce due to what they call turbulence in the cryptocurrency market. Online stock brokerage Robinhood cut 23% of its employees. This is the second round of layoffs for Robinhood so far in 2022. Connected exercise pioneer Peloton has cut 800 employees, announced several store closures, and raised prices. Even companies that are not considered to be in the technology space are announcing job cuts. Walmart is cutting 200 corporate employees. The job cuts are focused on merchandising and real estate. Car giant Ford announced that it is cutting 3,000 salaried and contract workers. The job cuts are in India, Canada, and the United States. Wayfair, the Boston-based home goods company, Wayfair is cutting 870 employees worldwide. HBO and HBO Max cut 14% of its employees, which is about 70 people. Bed Bath & Beyond, the latest meme stock, is cutting 20% of its corporate positions as part of what management calls a major restructuring. It is also closing 150 stores. Dallas-based health services company Signify Health is cutting 500 jobs. Electronics retail giant Best Buy has cut hundreds of jobs in its stores across the U.S. due to what they call a challenging macroeconomic environment. Online prescription glasses retailer Warby Parker is cutting 63 corporate positions. This is about 2% of its worldwide employee base and 15% of its corporate jobs. Electronic payment processor Fiserv has cut an unspecified number of jobs. Software analytics platform Sisu also cut positions, but declined to say how many. Google, which has not yet formally announced layoffs, said that there would be an overall review of sales performance and performance in general. Despite the number of employees, Google seems to be underperforming as a company. Recently, Pichai shared his plans about a hiring and investment slowdown through 2023. Pichai is publicly asking employees to work with greater urgency and more hunger. Meta Platforms CEO Mark Zuckerberg announced a layoff of 11,000 employees. Realistically, there are probably a bunch of people at the company who shouldn't be here, Zuckerberg said. But what do you think? Please leave us a comment below and hit the like button. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. Please share this video on social media. Thank you for watching.